but I really do believe the Fed is making a mistake.
How's it going, everyone? This is Daniel. In this video, we are going to be talking about Tesla stock and the overall market. We're going to go over and look at what to expect for the overall market next week. We have some important economic data coming out that could significantly affect the overall market. We're also going to be hearing from Cathie Wood. She talked about exactly why the Fed raising interest rates is pretty bad. We're going to be talking about all this important information coming up, and we're also going to go over technical analysis for the bull market and for Tesla and what to expect for this upcoming week. So make sure you stay tuned. Now let's get right into the video. So as you can see over here, we have Tesla stock that aggressively sold off on Friday. We've been seeing a lot of selling with the Tesla stock. Last week we're down minus 12.3%. So hopefully going into next week, we might potentially see some form of a bounce. But overall, we're expecting some massive economic data that can affect the overall stock market coming up. So we'll be getting the core inflation data coming up next week on Thursday. So that could be a significant market mover. And as you can see, the overall market is also pulling back to the downside based off of the unemployment data that we got on Friday. So that was pretty aggressive sell-off that we've seen. So overall, going into next week, these are going to be the major market movers, getting the inflation data for September, and we're going to see what the Fed is going to be doing ahead of the November meeting coming up, the November interest rate hikes coming up pretty soon. So as you can see over here for Tesla, we've been selling off aggressively. We've been getting lots of news with Elon Musk Twitter, the delivery numbers that came out lower than expected, and the earnings is coming up in October 19. So we've been talking about, okay, we might potentially see Tesla stock sitting between 215 to 250. We might be sitting in this range for the next couple of weeks, for the next couple of months to come. But if we get a massive surprise on earnings, and also with this inflation data that we're going to be getting pretty soon, things could definitely look different than we expect. So just be aware, we are going to be getting some massive moves with Tesla and also the overall market for this upcoming week. The overall market is sitting at a very critical level right now. As you can see, we started to recover, but unfortunately some of the data that we're getting is not really going to change what the Fed is going to be doing. So they're still saying that they're going to be raising interest rates in November, but we're going to be hearing from Cathie Wood talking about exactly why the Fed raising interest rates is pretty bad for the US economy, also globally. There is a lot of issues happening across the world. We know what's going on in Europe. They have energy crisis going on. We have inflation, other countries just skyrocketing, etc. But let's go over here from Cathie Wood what she has to say. And then we're going to come back and then we're going to go over what to expect for Tesla stock for tomorrow. So first, let's check out the video.
Monetary policy. Well, let's just look at the numbers first. M2 growth peaked at 27% in 2020 and has been slowing ever since. It hit 4.1% in August. We believe it is closing in or might be below 3% on a year-over-year basis in September, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned and are spending less freely. So if you look at M2 also, you'll see that it actually peaked in March. Now, this is very unusual to see sequential declines in money. We have not gotten back above that March peak, and we may not get back above it the way that Fed policy is going. And I think I'd like to build the case a little more here that the Fed is probably making a mistake. I say probably because I have to from a compliance point of view, but I really do believe the Fed is making a mistake. Reflecting a little bit more on the Jackson Hole speech that Chairman Powell gave in late August, we've we've come to recognize that Chairman Powell really does think he is the reincarnation of Chairman Volcker, that we need him to take a sledgehammer to inflation, much like Volcker did. And history has treated Chairman Volcker very kindly. He did turn the tide on inflation. Now, what he did, though, was he turned a tide that had been building for 15 years. It started in 1964 with the Vietnam War and with the Great Society. So many social programs started at that time under President Johnson. And for 15 years, fiscal and monetary policy pretty much went rogue as we look at history. Even after shocks to the system, like the oil embargo, the stimulus that came about because of it, both monetary and fiscal policy, we never saw the kind of slowdown in monetary and fiscal policy that we're seeing right now. Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. And so Chairman Volcker did choke off money supply and killed inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think many people believe it peaked, as it did in 1981, until 1986 when oil prices crashed. So the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem. It was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the COVID panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations. And yet, Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now, and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate another 75 basis points on November 2nd. And what do I mean by that? Well, Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. So while that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed. Today, we've gone from 0.25% on the Fed funds rate to 3.25, which is a 13-fold increase, not a 2-fold increase. Now, many people, I was interviewed by someone the other day and said, oh yeah, but that was such a low base. There's no comparison. In fact, that makes this even more dramatic. That's what's so interesting. People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 9, because we were in a terrible crisis then, and it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different. It's such a low base. That's the whole point. It's a low base, 13 times.
So as you can see right here for the overall market this week, we might potentially see a big move for, especially on Thursday. If we break it down, we have a strong support around 350. And if the numbers actually came in as expected, if inflation actually goes down for the period of September, we might actually bounce back up. The overall market could overall recover, which is pretty good. When you look at Tesla too, we have earnings coming up for next week. You know, we've been getting a lot of updates about Elon Musk, Twitter. That is also some form of a bad selling pressure that can have an impact for Tesla shareholders, unfortunately. So the key price point level that we're watching for Tesla is around 215. This was a support that we're watching. And if we can stay above this 215 area, maybe get a bounce on Monday, it will definitely help the stock to recover in the short term. As you can see, we've been seeing a lot of selling pressure for Tesla stock for several days. So hopefully we get a bounce, and I expect at least to get at least one green day for Tesla stock to come for this upcoming week. But let me know in the comments section below, what do you think is going to be happening? You know, we have Tesla earnings coming up on October 19. We're going to be talking about what to expect for the earnings on the next video tomorrow, maybe the day after that. But overall, let me know in the comments section below what do you think about the price action, and also what the overall market could potentially be doing for the next few days. I'll let your opinion. But of course, if you're new to the channel, make sure you subscribe to the channel, turn on the notification bell. But I'll catch you guys on another video. Have a wonderful day.